not locked in here with you. That's it! You're locked in here with me!
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Coming to you from my underground lair, my Rebel underground lair, here in beautiful Silicon Valley, California, with some more real estate insights for you today. Also ready, willing, and able to help you with any real estate needs you might have. So if you're interested in buying or selling real estate in the Silicon Valley area, all the way from Gilroy all the way up to Mountain View, give me a call. Happy to talk about what the market's doing and how we can give you the best possible deal. You can find me at www.soldbyrobert.com or for the show, www.therebelbroker.com. Okay. Interesting report out today that we can chat about. I'm trying to be super focused today. I've mentioned this before. I usually walk in with 4 or 5 articles that are potentially things I want to talk about. But what we're going to look at today is Zillow's most recent report on the market. The headline from them is home value growth expected to reaccelerate just in time for home shopping season. I thought this one fit in well with our chat yesterday relating to inventory numbers being down, demand numbers being up in so many different communities that we look at. What's really cool about this one, and there will be a link to this article in the show notes for today's show, is embedded in this article is a great little tool that we might go ahead and make use of. They've got the Zillow Home Value Index. Now, for those of you who've been listening for a while, you know that my first thought then is to figure out how do they calculate the home value index if they're basing it just on what Zillow's algorithm says homes are worth. That's less interesting to me. If it's based on actual sold data, that's much better. What is sad is that, and I'm sure they maybe have this somewhere, but as I always suggest you do, I do not see the methodology here. I don't see a link to the methodology or anything relating to how do they figure this stuff out. So let's go ahead and just take it at face value here, because there's several great chunks of data, and here's what's awesome. So we try here to share information in a way that lets you translate it into locally useful actions you can take, right? I can't tell you if that home for property on the street 1 block over is a good investment, right? But I can try to give you tools so you can figure it out. I can try to give you perspectives and other kinds of cool stuff, methods, so that you can figure it out on your own. So we try to make the general stuff we cover into guidelines, into ways you can explore the market. And this is kind of an interesting article that hits on a lot of the key things we talk about all the time on this show that everyone should be mindful of. And not just investors. I mean, I know I get an awful lot of folks who reach out to me who are investors, but I get I don't get quite as many, but I get an awful lot of folks who are buyers. I get folks who are interested in selling their home, get a ton of real estate agents. But this is data that is valuable for anybody. If you're a buyer, it's calibrating you to what's going on in the market, what your expectations can be relating to what you might have to spend, and hopefully gives you tools to find the biggest bang for the buck for your money when it comes time for you to shop for a home. If you're a seller, it helps you figure out what numbers are going on in your area or what ways to look at numbers to help inform you on what's really going on in your marketplace, so you're not just relying on what a real estate agent potentially tells you, right? With the amount of information floating around out there on the internet, there's really no excuse to not get yourself some of your own data and go through that listing process with an agent more informed, or with information in your pocket before that first real estate agent even walks through your front door, to try to pitch you on why you should list your home with them. Okay, so let's go ahead and run through this. The first tidbit here, they've got their bullet points, right, that they hit at the top of the article. The typical home in the United States is worth $245,193. That's up 3.8% from 1 year ago, right? So overall, a 3.8% increase year over year. There were about 1.5 million homes listed for sale in January, down 8% from a year ago. And the typical U.S. rent grew 2.3% year over year to $1,602. All right. So we're already seeing good news for investors, right? Particularly if you're a buy and hold investor, because you're seeing a continuing increase in your rental rates, what you can potentially charge. Now, depending on your small local market, given the numbers we talked about yesterday, I don't see reasons why anyone who would purchase a home for rent right now should worry that rents are going to go down in the near term. I'm not seeing enough of a change going on in terms of new homes coming on the marketplace that would indicate to me that opportunities for you to lose renters in a way that would make it competitive against you is coming, right? So I think I think the buy and hold strategy is still a super good one. That's a personal bias of mine, so just be aware of that. I am a very pro buy and hold guy. I like the idea of turning a home into an income stream. And I think over a long term, it's a great return. And the best part is typically when it comes time to then sell that property, you're then going to be able to enjoy appreciation, right? And I know this isn't what this show is specifically about today, but let me just remind, this is the time of year when all of you folks out there who own properties should be doing an assessment of your property. And what I mean by that is, what's everything costing you? And of course, you're already doing this for your taxes, but you should also be not only assessing what everything's costing you, whether or not it's time to raise the rent or those kinds of questions. You should ask yourself, what is my home worth today? How much equity have I built up? Is this now a time where I should sell this home and perhaps buy a home in another market, maybe even in the same city, right? We talked about micro markets yesterday. Maybe you've spotted what you think is going to be that growth market. Maybe gentrification is right around the corner on this one area and you've spotted it, right? Maybe it's time to move that money into a new property and reap the rewards that can come from that, right? Buying on the low side because you anticipate a high side. Absolutely, there's a risk there, but if you've been a property owner and an investor in those areas, hopefully you've been keeping up with what's going on with the market, so you're a little bit more informed than the average person in that town. Okay, let's get back into it here and try to see what pearls of wisdom we can suck out of this one. Let's see. Among the nation's 50 largest markets, annual home value growth in January was fastest. The rate of increase was fastest in some interesting cities. There's one city on this list, no, two really, that we haven't really talked about. I think we may have talked about this one 2 years ago, but anyway, let's jump in. The first one is Memphis, Tennessee. Now remember, I'm a fan of Memphis. I've talked about Chattanooga. We've had folks on the show. We've done interviews with folks. I'm almost sure we had one who is a Memphis person. 6.9%. Home value growth in Memphis. Phoenix, 6.7%. Phoenix comes up all the time. Every single year, we see growth in Phoenix. For my money, Phoenix is super stable from a renting standpoint. Remember, we've looked at Phoenix numbers, and while it did get hit by the downturn, rentals survived really well, as did in most markets, to be honest. So that doesn't make Phoenix terribly unique. Birmingham, Alabama, 6.3%. That was the one outlier, but I'm almost sure Birmingham came up on our radar this time last year, or maybe it was the year before in terms of anticipating growth. So maybe this is maybe just a manifestation of that. When we discussed this a year or so ago, we were correct, right? And they enjoyed the most growth over the year following that discussion. Here's areas, and here's the other number that I think is super interesting. It definitely dovetails in with what we were talking about micro markets. Now, the show I did on Monday, I got interesting comments on that show. A couple, I think it was either on YouTube or maybe it was LinkedIn, and they were talking about how there's tons of inventory available in San Jose, right, which is a Silicon Valley city. one we talk about a lot. And on this list, growth was the slowest in San Jose with negative 2.9% home value growth, according to this. Let that sink in for a second. For those of you who've been around for a while, you know we've done numbers on San Jose that are insane. But here's the thing about San Jose. San Jose is gigantic. It is absolutely huge. If there is a city that defines the need to embrace micro market calculations in terms of calibrating you to what is and isn't a market you should invest in, it's San Jose. Anybody who just says this is what's happening in San Jose doesn't know about San Jose, because you can't say it, right? There are absolutely areas of San Jose that demonstrate this decline. Remember, I've talked before, this is one of the areas that I track all the time. I am looking at data relating to places like San Jose almost daily. And I talked a couple of weeks ago about checking out that Trulia map or that Realtor.com map and looking for properties that have that little red arrow going down, right? Or for some, it's a green arrow because it's a good thing, but prices being reduced. Absolutely, there are tons of areas in San Jose where that's true. East San Jose, Central San Jose, just a little bit south of Central San Jose. But then there are areas that are not like that. Extreme west end of San Jose, southwest San Jose, extreme south San Jose, right along the 85 freeway, right where it goes and all the way over to where it meets the 101 and the Evergreen area. Those are areas that absolutely are not representative of this negative 2.9%. So for those of you who live in other areas, you could probably be sitting here behind this microphone saying the same thing. I haven't been yet. I mean, I've been, but not as an investor. I've been to Atlanta. I've been to New York, been to Miami, been to Charlotte, North Carolina. I'm willing to bet the exact same thing is true of those metro areas, right? You can't say this is what's happening in Charlotte or this is what's happening. I know you can't say that in Miami. When I was there, now granted, I was there in the dark ages, but there are parts of Miami that are a demilitarized zone, right? And then there's other parts that are freaking amazing. Beautiful architecture, a lot of Art Nouveau stuff going on. So a huge variation in these marketplaces. So if you're saying, oh, the bell has now tolled for San Jose, in neighborhoods, some areas, maybe not so much. However, you should also be aware that this is just the reduction in the growth, right? This is the home value growth. So prices are still up, but the growth was down 2.9%, right? So in a lot of these areas, it's not that homes are worth less, because they're not. It is that the growth is slowing. New York was 0.8% growth. San Francisco, 1%. So what's amazing about this? These are the metros that had the slowest growth. Remember, and this is a song we have sung here many times, stop investing in these places because they don't make financial sense. They don't make math sense. And I've been advising that now for a couple of years, and this is kind of the result of it, right? I think we've hit sort of a plateau here. All right, so annual home value growth in 27 of the 50 largest U.S. metro markets was faster in January compared to December. Duh, right? We understand that, right? We understand why that's a duh. January is when the market tends to start to get going these days. Used to not be, and it depends on your local market. But I know here we start to see buyer interest in homes grow in January. Now, maybe you're not going to see that in, I don't know, where's it snowing a lot right now, right? For most places, we are in winter still. Now, while calendar-wise, California is in winter, but as I look out the window, as I drove up to my house today to sit down and do this show, it was 77 degrees outside, right? So our season is going to start a little differently than yours, depending on what kind of area you live in. Okay. and was flat in one additional market. Oh, excuse me, U.S. metro markets was faster in January compared to December, of course, because December is also, everyone takes their home off the market in December unless they really, really, really need to sell. Buyers tend to stop being as numerous on the ground. Why? It's the holidays. It's Christmas. People are more focused on having their house for family than they are for showing. One interesting note, if you do stick to it as a buyer, as I had one of my buyers do this last year, you're going to get your best deals with the lowest amount of competition in areas where there's a much greater level of demand, a la the micro market argument we were making a minute ago. Okay. The slowdown has already reversed itself, according to Zillow, in many places, and it may be only a matter of time before that reversal will begin showing up in faster national appreciation numbers. Now, so the first chart that they lay out here with their Zillow Home Value Index, and what I'm going to do, I'm going to read off I'm going to describe what we've got in one region. And I'm going to go ahead and I want to pick a few representative samples. I want to maybe try to do San Francisco Bay Area, maybe San Jose, maybe Miami, Phoenix, Los Angeles, right? Maybe a few areas. I'll pick a few across the country, and we'll see what we're looking at in terms of growth. And right near here for the United States, we already talked about 245,193 for January of 2020. Lots of growth starting in March of 2012. So in 2012, things started to grow across the country. We saw a trough that in February of 2007, we peaked and then peaked again. That we beat that peak in, looks like, March of 2017. But between those two dates is a bit of a trough where it goes down to 160,263 in January of 2012. And then prior to that 2007 January date where we had a previous peak, it goes way down, all the way down to 1996, where we see January 1996 at 106,000 as the Zillow Home Value Index for the entire country. Okay, so that calibrates us to kind of the general trend. And again, I will have a link to this article in the show notes, and it maybe it'll even be worth doing a YouTube video on this one, so folks, we can walk through the charts together and have a chat while you're actually able to watch. In terms of other regions, let's pick one that jumps out at me. It's a pretty good list here. What have we got? Atlanta. We talked about Atlanta. Let's take a look at that. So this is the same index, which didn't let me pick Atlanta. Why did it not let me pick Atlanta? It went back to the United States, Atlanta, Georgia. There we go. Very similar, 239,115 is the current Zillow Home Value Index in Atlanta. Same kind of trough, same kind of peak just prior to the trough in let's see, it looks like June of 2007 at 198,828, and then in January of 1996, 119,255. And then let's pick another one. Let's look at let's see San Jose. We talked about San Jose. It takes more scrolling to get to San Jose. They've got an awful lot of markets here. I'm going to strongly suggest everyone take a look. I wonder if my city's listed. It can't be, right? My city's too small. I'm going to, just to indulge me, no, it is not, which makes sense. My city is tiny. All right, so let's do San Jose. Okay, very different freaking chart, but still interesting. There is a little bit of a trough in around the same time, but the peak is not quite as high. But here's the numbers we're talking about. So the January 2020 numbers are the home value index is 1,194,002. But here's what's interesting. What this has that others did not have was this bizarre peak in July of 2018 where we peaked at $1.3 million for the home index. So we actually had a drop in that particular month. And you know what? Is that also the month where we had the sale of one of the most expensive homes, like a $30 million home? Granted, the amount of volume that happens in a month would be hard to offset by that. But anyway, no, because we get previous months that roll up to that. So that was where we had our peak. We were actively doing shows then and analyzing that. But this was really much more of a subtle grow, but all of these numbers are crazy. Going all the way back to January of 1996, 258,342 was the value index there. Now, let's go ahead and look at a place. Let's look at Boise, just because Boise is a place that I've talked about so much in terms of places that are on my list. Right now, it's at 313,183 as of January of 2020. Same little bit of a trough here down to 135 in October of 2011, and a kind of flat peak from what it looks like November of 2006 to April of 2008, where it really hung around, 210,000 for that entire period of time. And then saw that dip down when we had the same dip in most other communities. So what I'm going to suggest you do is take a look at this and get a feel for how your community, your city in the capital C sense of city, performed. Let's look at Phoenix as well. I know this is compelling audio when you get to listen to me scroll through a list. Phoenix. I could just type it in. God, what an idiot. Phoenix. There we go. Let's see what Phoenix looks like. Wow. So this is a great example of why this information is valuable. We've talked about before understanding how other communities have fared in the past downturn. And the argument I've made is that there's two layers to it. There's the what happened, and then there's the why, right? And the argument I've made is it's actually, in a lot of ways, more important to know that it happened rather than to know the why, although I'll argue spending some quality time figuring out the why is absolutely worth your time. Because if you can figure out the why, what was going on in Phoenix that made things go this way, you're on your way to being able to spot similarities in a potential future downturn. So let's talk about Phoenix, Arizona for a second. So January 2020, $288,708. Pretty good, right? Well, it's pretty good until you realize that they have not yet reached their peak from May of 2006, which was 297,000. It was 297,000 and something. 297,000 in, it just keeps jumping around on me here, in June of 2006. Big trough after that, had a pretty steep drop to where it bottomed out at 134,990 in June of 2011. But I think what a chart like this should tell you is Phoenix had a really rapid growth spurt from January of 2004 till it hit that peak in 2006 that we talked about. So thing number one to figure out is, why did that happen? What was it about Phoenix that made that go up? Was it just straight up easy loans, and not enough inventory, so folks just bought crazy and forced those prices right up? And then in terms of this dramatic drop to the point where we haven't even recovered yet, what feeds that? And then finally, do we take this as a sign, since Phoenix has not even reached its pre-downturn peak, that there's still a ton of upside in Phoenix? Or was the upturn prior to the downturn in Phoenix so artificially supported that we shouldn't even really consider that as rational real estate days, right? Or more irrational than other areas. So these are things that we can look at. The layout of this chart makes Phoenix, again, super interesting to me. You know what? I want to see if Chattanooga is in here. It is. Chattanooga's here. Let's see. See? And this is another example of the other end of the spectrum. Man, can I pick them? So Chattanooga does have a bit of a dip and a bit of an increase. But I got to tell you, not much. The peak is at November of 2007, about 141,000. The low point is April 2002 at about 120,000. And then it has slowly grown up to January of 2020 of having 174,894. What's really super interesting is if we were to plot what looks like the normal growth rate that was happening from 1996 And then if we stop counting the crazy times, right? If we stop around 2004 and don't take that little hump that happens there as part of the crazy buildup to the downturn, if we just plot a straight line along there, we are still below. If we just had linear growth, and think this looks pretty linear aside from the downturn, we are still not at the point where prices would be, assuming that linear thing holds any value for us. Right? I hope I'm painting a good enough picture here for you. So what's my point? My point is that this chart makes me think I need to look at Chattanooga again and get my butt out there and see if I can't find something awesome, right? Okay, so take a look at these in markets that you're interested in. In the shows that I've done over the last couple of months where we've talked about cities that have been picked because they have a great return on investment, check this number, check this chart. Get a little bit of historical perspective on how it responded to the downturn. Did it get really hit upside the head, or was it like a Chattanooga where things were kind of meh? Not really a whole lot happened. All right, so now, at the same, and going on with the article, at the same time as the ongoing slowdown in home value appreciation has largely bottomed out, the number of homes listed for sale remains incredibly low. Inventory increased from record lows a month earlier, but was down 8% year over year in January, the biggest annual drop since March of 2018. There were 1.5 million homes in the market last month, up 4,200 from the previous month, but down 130,000 from the same time last year. So let's go ahead and cover these same numbers we talked about before in terms of inventory was down year over year in 47 of the nation's 50 largest metro areas. For sale inventory fell the most from a year ago so these are the areas with the biggest drop in inventory. Some familiar names are going to come up. 1, Seattle, down 27.26% year over year. Phoenix, down 24.5%. Now, I don't know a whole lot about Seattle. I know a little bit. I know enough to know where my kid lived when he was going to school up there and how he didn't live in Seattle. He lived in a peripheral city. But what I'm going to suggest is that while you see these inventory numbers drop, and Seattle's different, right? Because in Seattle, you've got the whole water between, if you live outside of Seattle, you've got water between you and the city. So you've got choke points of bridges that you got to deal with, which completely changes the landscape, right? Understanding the landscape of how people get around in the areas you want to invest is huge. So what I'm about to tell you is less impactful in a Seattle, right? Because the difficulty in getting into the city from, say, Redmond is huge because the traffic is nuts. Every time I was up there when it was even vaguely close to commute time was worse than I've ever seen here in Santa Clara County. So keep that in mind. So I wouldn't suggest that tells you go look at Seattle, but I think it does tell you go look at the suburbs of Phoenix, right? If you're a investor and you're looking for that great deal, I still think Phoenix is a great place to go. Even though inventory is way low and it is tending to push prices up in terms of having to deal with the demand, increased demand with lower inventory, that's not going to be true in every suburb of Phoenix, which we're not seeing reported here, right? Next, San Diego, another place that's going to have suburbs. Their inventory is down 23.1%. And these are the 3 largest drops from 1 year ago in terms of inventory numbers, right? So let's go broader and try to stick to just the cities. For you, if you're a buyer, this tells you probably don't want to buy in those cities. Maybe get some numbers, keep a search going, talk to your real estate agent. If you find something you like, make a reasonable offer on it. But if you're constantly finding that you're getting trampled on by other buyers, maybe it's a suburb move for you. Maybe that's what you need to do. If you are a seller and you're in one of these areas, this may be your moment. If you own rental property in these areas, this may be your moment. With the amount of inventory that isn't on the market in these places, this may be the time when you can sell this at a rate that is going to be a great return for you as an investor. And then maybe you go ahead and buy a property in the suburbs or in another area where you've spotted a good opportunity. Okay, the 3 large markets in which inventory rose year over year. A couple of interesting ones here. First, San Antonio leads the pack with a 7.7% increase in inventory. I tell you, I have talked to plenty of people who think San Antonio is a awesome place to invest. I like San Antonio as a city. I hate the weather. I could never live in San Antonio. It is so freaking hot, people. I went to a wedding there once where the wedding had to start at 8 or 9 o'clock at night because it's just too hot. So the reception was like at 10 or 11 o'clock at night. And at 10 or 11 o'clock at night, we're at the reception for the wedding, and it is so hot and so humid at that hour. It was painful. I'm sorry. I can't even begin to explain it. Anyway, next is Detroit with a 6.4% increase in inventory. Then we have Chicago with a 0.3% increase in inventory. So in chaos, there is profit, right? That's a line I've heard before. And there are absolutely, I have no doubt, areas of Detroit and Chicago that would represent a perfectly wonderful investment. Drive-bys are not happening on every street of Detroit and Chicago. So there could absolutely be some great opportunities in those cities. I feel like I should say something else about that. I guess would be careful if you're not familiar with those marketplaces. I personally am not going to go to anyone. I would go to Chattanooga before I'd go to either one of those places. But I do pause and think, well, you know what? That could be opportunity. And the same goes for San Antonio. You don't have to want to live somewhere to invest there. There are plenty of people living in San Antonio. Because remember, you're not buying this house for you to live in. You're buying this house for other people to live in. Anyway, okay. In terms of Zillow for sale inventory, they've got this chart is kind of amazing. And again, you can pick it by city. The inventory right now, January of 2020, is 1.5 million. It has been steadily, with slight variations, it's been pretty much steadily going down since January of 2013, where it was at 2 million. I would love to have this chart go back further. What a shame. Can I not? I can download this? Wow. No, it's only an app. Or a Tableau workbook. Maybe it downloads all the data. But anyway, sorry. So you can see what happens in the entire country. Then we can do the exact same thing we did for other places. So we can try Boise, Idaho. We did Boise before. Inventory is down. Oops, see it? That's really weird. It doesn't. The very first time I try to do it, it does not take my change. Inventory is actually up in the near term. It's up since like August of 2019. It was low in July of 2018. Then it rose until February of 2019, then kind of started to go back down and bottomed out at August of 2019, and now today it's up, which I think spells good things. I mean, we've already heard good things about Boise in general. If inventory is up, that's great news. Nowhere near the peak in terms of inventory, which was back in October of 2014. What were some of the other cities we looked at? Let's look at Phoenix. Phoenix, Arizona. Way down. Huge drop. Well, not huge. Well, from the in terms of what direction the line is going. From May of 2019, we saw a drop. There were 26,000 in inventory, and it's dropped to January of 2020. It's dropped to 20,000, 19,500. So pretty substantial drop, which is uncharacteristic. So this is another chart that makes me stop and think for a minute. Why, if we go all the way back to 2013, January of 2013, do we see this kind of meandering up and down without a whole lot of decline? And then in around 2016, we see a little bit of a drop, and then things sort of flatten from March of 2018 to May of 2019. And then suddenly things just go way down. What is up with that? That feels like a uncharacteristic inventory drop, which might warn me against making a purchase right now just because of the pressure related to lower inventory. So something to think about. All right, and last but not least, I want to talk about rent indexes. This is another area of this story that I think anybody who's interested in potentially being an investor should take a little time out to look at this. I think it's a great way for you to at least get a ballpark feel for what's going on with rentals. Now, of course, this is going to be the average rental in these areas. It's not going to be for a 3-bedroom, 2-bath, whatever. You need to go through some of the hoops we've talked about before relating to that to find out what the rental rate for a comparable property that you're looking to invest in would be. Now, if you look at my most recent video in terms of training, in terms of evaluating properties, I cover that in that video, so check that out. And soon, I had a request from a listener to do a deep dive into analyzing a specific property. So once you've analyzed you've analyzed the area and you've come up with a property that feels good, what's the detail you should get into on an investment property to decide to go ahead and make that purchase? That'll be an upcoming video on YouTube. So, okay. The article goes on, but as the economic storm clouds on the horizon in early 2019 cleared up, we saw buyers return in droves, taking advantage of ultra-low mortgage rates. This first look at 2020 data suggests we could see the most competitive home shopping season in years, as buyers are already competing over near record low numbers of homes for sale. That is likely to mean more multiple offer situations, and the buyers will have a harder time finding the perfect fit for their families. So my personal on-the-ground experience is that this is true. I am seeing a lot more buyers coming out interested in purchasing, and I'm not seeing as much inventory out there to satisfy that demand. This article states the good news for buyers is that low mortgage rates are helping to make homeownership more affordable, which is shallow comfort if you end up having to bid $10,000 over asking price or $20,000 over asking price. All right. Now, let's talk a little bit about rents. We already discussed that they were up 2.3% year over year. Right now, across the United States, they sit at $1,602 as of January of 2020. Steadily increasing since September of 2010. I don't know why this goes back years further than the other data did, but it does. It was relatively flat from September of 2010 until about June of 2012, and then it just started its rise, and it has been going pretty steadily since. And that's the national number, right? So let's go ahead and take a look at another one. Now, we looked at Boise before. Why not look at Boise again? And, of course, the first time I tried to make the change, it worked this time. Same model. Really just a basic increase to a top end now in January of 1,388. Let's look at San Jose and see what it says there. Really kind of interesting. So it peaked way earlier, and it's been relatively flat since January of 2016. And you know what? My personal experience confirms that. I mentioned that I was considering the possibility of selling my home and moving into a rental. And that's actually been almost since, not quite going back to 2016, but it's been relatively flat. We're at $3,302 today. In December of 2015, it was $3,282. In September of 2016, it was $3,301. In September of 2017, it was $3,262. In September of 2018, it was $3,304. So let's do September 2000. So September 2019, it was $3,320. So it was more, right? So this is super interesting. This also feeds the argument we've been making. So while we were seeing increases in home values, and that's why the home value index we talked about first and this one are great ones to consult side by side. In so many of these cities, while you've seen home prices go up, you've seen rents go up, right? Well, how much have the cost of buying a home in San Jose gone up from December of 2015 to today? Well, according to this rental data, on average, you sure as heck haven't been able to get much more. So that's why the ability to get return on investment in San Jose has been almost impossible unless you drop tons of cash, which ends up being very low return on investment for a huge investment in cash. Now, if I go ahead and I look at the San Jose value index, okay, it did that whole not San Jose, but the entire country thing again. Let me just try that. Yeah, when we already discussed this, it had this bizarre little peak in 2018 at 1.3 million, and right now it's at 1.194, so about 1.2. But all during this time where rents have stagnated. Let's see, where was the flattening? So it kind of goes all the way back, as I said, to November of 2015. If we look at that for November of 2015, the average home price was $948,926. And over that same period of time where rents were staying relatively flat, we saw things peak out at 1.3 million, right? That is a bad math problem for someone who wants to rent a house. So I think that kind of seals it in terms of why have we been suggesting for so long that you should not buy a rental property in San Jose or in Silicon Valley or in San Francisco. A lot of the same things apply there. Okay, so I think this is a great resource. It's definitely something you can add to your tool belt in terms of having not a micro look, but a macro look. And again, what I would suggest is as we go through different reports on this show, or I talk about different communities that look good for investors or have had good performance over the last 6 months or a year, or projected to have great performance over the next year, consult these charts. See if you can't discern the influence one thing has over the other, or whether or not you're seeing the rental rates that make sense given the property values or the sales price of properties increasing or decreasing. All right. Well, folks, that went on much longer than I had intended. I thought it was going to be a short show today, but this ended up being such a rich mine to dig up in terms of information that we went a little bit longer than planned. But as always, the goal is to leave more value on the table for you than time you've invested. And I absolutely think we've done this. This is a great tool. I want all of you to check it out. Take that as homework. Thanks for listening, and I'll talk to you all next time.